Santosh Navlani of ET Money. Santosh, thank you so much for giving your time to ET now. Firstly, would like to know that in this particular time when we see that in Indian markets, forget about the large caps, even the mid cap and the small caps, they are so much at low price from their recent highs. What mistakes actually investors make in such situations?
Yeah, so we have the saying internally, Shishti, that in markets, if you don't convert your paper profits into real ones, then market corrections may force you to convert your paper losses into real ones. Just to simplify this, it's like if we always sit on gains in the bull markets, and it's really important to take some gains off the table and safeguard those gains, protect those gains. And if we don't do that, then the correction that we're witnessing in the marketplace today, may actually become so steep at some point of time that you would try to start thinking about gaining protecting whatever gains you have made even after corrections. And then what you are ending up doing in the process is you're letting go of a lot of profits that you could have made, if you continue to held on again. So what happens is when markets actually become very volatile, sometimes emotions take over our investment habit completely. And in emotions, we panic, or we at times just miss out on opportunities of reinvesting again. And rather than reinvesting again, you actually exit money. So it's very important that one has an exit plan in place. Otherwise, market will force you to exit at wrong prices. Is how we should be looking at.
And we see a lot of Indian investors as well getting stuck out there. But if one has to plan an exit strategy, then which best ways are you going to suggest to our viewers? In what way they should go about planning this?
Yeah, so it's very easy, Srishti, to say that one should have a target price in mind, and when the target price is met, exit. The target price can apply to stock prices, or target can apply to mutual fund returns on the portfolio level. And once your returns or the target is met, exit. It's very easy to say, but very difficult to follow. But because the fact is, nobody knows what the right target price or target returns should be. They're always relative in nature, and you don't control returns. Returns follow, and returns are given by the market forces and not by you. So while it's the most simplest way to say that have a target price in mind, that is something which never happens in real life. So to really have an approach to exit, there are possibly only two ways to do it. One is having some kind of a plan in place where you are investing towards a goal or having a target value in mind. So for example, you're starting investing a few thousand rupees of SIP every month, or some amount of random ad hoc investments every few months. You're investing towards a goal. You have a goal value in mind. Say after 10 years, after 5 years, for 7 years, I need so much value. And when you are nearing that amount, instead of being greedy about it and trying to overshoot that target, you should first safeguard that investment and say that let me move some money off the table, put into safer investments, because I am in a good distance where I can actually reach the target value. So prioritize the reaching the target value of the goal that you have in mind, instead of actually saying that let me maximize my returns now and overshoot my target. And again, this may be a bit difficult for people to follow, because one wouldn't know that should I start exiting from market 2 years before my no goal date, or 3 years before, or 6 months before. Hence, it is important to have an asset allocation plan in place around it. So in ET Money, we believe there is a need of having a glide path, as we call it, which means that as you are progressing towards your goal date or target date of withdrawing money from the market, start cutting down your risk periodically, and start moving your money to safer assets. To put into example, suppose you are investing for a 7-year goal, and you are following an asset allocation plan that 85% of your money should be into equities, and 15% should be in safer assets, say gold, fixed income, or cash. As you are progressing, say year one, year two, irrespective of whether you have gained some profits or not, you should safeguard some of the money and ensure that you may not be sitting at 85-15, but maybe 75-25. because the fact of is you have only 5 years left to make up for the gains now. And if you go towards further in year 4, year 5, and only 2 years are remaining, you should actually be ensuring a lot of your money is into safer assets. And if you plan this well, what will happen is in the final year or last 12, 15 months when the you are about to withdraw your money from the markets, you would notice that even if a big shock comes in, a big correction comes in, a big drawdown comes in, you would not really lose your patience or lose your cool and panic and sell something at wrong prices, because only about 15 to 20% of your money would be in equity markets and rest would be in cash or debt or fixed income. And if you follow this approach on a periodic basis, that you review your asset allocation every year, every 6 months, and start moving your money into safer assets, automatically you would notice that you are booking profits as you are moving from equity to debt and moving more and more of your money into equities, into debt, sorry. So having a glide path, having a asset allocation plan for every year of your investment tenure can actually be much more methodical way of booking profits than actually having a target price in mind.
Absolutely, Santosh. And these days, we are getting a lot of discussion and trying to educate our viewers how they can invest in debt funds as well, because they seem to be giving constant return over a period of time, but they do have some of the constraints out there. But now talking about a fund which has been a consistent underperformance. It has been weak, and during these volatile times, it definitely goes into that weaker trajectory. What would you suggest if a investor is stuck in such kind of a situation? What should they be doing?
So I think it requires some kind of thoughtful decision making, Srishti. If one is invested in a set of funds and one or two of them are underperforming in investors' opinion, the first job is to first verify whether the opinion is correct or not. Look at the returns of the benchmark that the fund is tracking. Look at the category average returns of that category, and then only decide whether the fund is actually meaningfully underperforming or it is your perception. So, for example, if you were invested in a thematic or a specific strategy like value investing from 2020 or earlier part of 2020 or even early part of 2021, and if you look at that, your value fund that you're putting money in is underperforming with respect to Nifty, you would notice that may be a wrong benchmark to have. You need to look at what is the right benchmark of value fund, which is the category average of various value funds in the country. And if your fund is a very big laggard in the returns chart that point of time, that's where you really first conclude that your fund is underperforming. And at that point of time, you should look at whether the underperformance is recent or has been a consistent underperformance of few quarters. And only if it is confirmed that it is underperformance of few quarters, it's that time you should probably plan an exit and search for a right opportunity, a right avenue to redeploy that capital. Sometimes when you look at underperformance and exit, you actually then start timing the market and say that let me now wait for the right opportunity to invest. That is pretty wrong in our opinion. When you are exiting from underperformance, you should remember what kind of strategy you have been investing and whether the strategy continues to be attractive. So if you are a believer in value investing strategy and your value fund has underperformed, you're moving out of that underperforming fund, you should go back into value fund because you believe in the strategy. If you're invested in large cap fund or a mid cap fund or a small cap fund or a multi cap fund, and your that fund is underperforming, if you're removing your money from the underperforming fund, redeploy that money immediately into the same corresponding strategy or a corresponding fund in the category instead of actually waiting for the right opportunity. Because if you wait for the right opportunity and looking for timing the market, you've done two problems to your hand. One is you actually lost out on returns by staying invested in the performing fund for long, and now you're waiting for right opportunity and market may not give you opportunity, so you're actually having opportunity cost of the money itself. So the right way to look at it is first verify whether your underperformance perception is right or wrong. Look at how long the underperformance has been, and then redeploy that money appropriately into the right strategy.
Santosh, now that we are discussing about the exit strategy, whenever I plan to exit, what kind of a cost should I be prepared for?
Uh, Shishi, so it's very important to understand what kind of costs are involved. But at ET Money, we believe being overly obsessed about the costs of exit actually may, result in you taking a wrong call about exit itself. Let me give you an example. We always believe, we always say that it's time in the market which makes more money than timing the market, and we say that let me follow this advice that I should not time my exit, and don't exit and keep staying in this for a long time. But if you deviate on your time decision by actually deviating from your asset allocation plan, then you may take a wrong call. So let's take the real numbers into account. That many people are not aware that Nasdaq, which is the bellwether of technology index globally, hit a high of 5,048 in March of 2000. And the next time it crossed again 5,048 levels was actually in April 2015. So technically, Nasdaq didn't return anything for a long period of 15 years. Even back in India, during the global financial crisis, they hit a high on Sextens and Nifty in Jan 2008, and the same highs were reclaimed only around November 2010. So again, the point is, people actually, if we follow their advice very blindly, that time in the market makes money, timing the market, and let me not bother about it, and don't have an exit plan into place, then all your returns can evaporate. And same thing will happen again if you take cost into account and not exit. So have a knowing understanding about the cost, but don't take let the cost determine your exit event itself. On the cost side, if we can look at, there are primarily costs in form of transaction cost and taxes. So when you are actually exiting from stocks, the transaction cost involved is the brokerage, is the securities transaction tax, and the tax that you'll pay on your capital gains, which may be in the form of short term or long term. If you're exiting from direct equities within 12 months of holding it, you would basically liable to pay 15% of tax on the short term capital gain that you're booking. And in if you're exiting after 12 months of holding period, then we'll be liable to pay long term capital gains tax. But with respect to long term capital gain tax and equities, there is a caveat that every financial year you get up 1 lakh rupees of free long-term gains, which are not liable for any taxes. So if you even use this 1 lakh gap, the 1 lakh waiver that you're getting from Ministry of Finance or Income Tax Department, you should look at that. Can I really rebalance my portfolio on first of every year up to level of booking 1 lakh rupees of profits and probably redeploy again? What is happening is you are actually getting 10,000 rupees worth of free money in the form of tax favor. So what happens is, look at cost also in the form of what advantage it gives you. It helps you to exit from the marketplace. It actually helps you rebalance your portfolio and from long-term capital gains tax point. With respect to debt funds, it's a bit different. If you are holding for up to 3 years, then the gains that you make on debt funds are added to your income and are added at taxed at the marginal tax rate that you're liable to pay for, maybe 10%, maybe 20%, maybe 30%, depending on income tax slab. But if you're holding the debt funds beyond 3 years, then you get benefit of indexation, and you are basically taxed only about 20% on the indexed gains, which basically turns out to be about like 4 or 5 or 6 percentage points in taxes. So the cost of taxes looks like a few percentage points, but the fact is they are on gains and not on a principle. So you should not bother about taxes or costs in isolation. Look at, are you right in having their exit right now, taking some gains off the table, and pay your fair share of taxes on that side instead of obsessing about it and not exiting itself.
Okay, thank you so much, Mr. Santosh, for joining us today on ET Now. And that was a very comprehensive answer, wherein each particular instrument you actually helped our viewers how they should plan their exit strategy. Thank you so much for joining us today at ET Now.